This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today. This is your daily real estate syndication show. I'm your host, Whitney Sewell. Our guest today is DJ Van Keuren. He's a member of the Forbes Real Estate Council, author of Real Estate Investing for Family Offices, founder of the Family Office Real Estate Institute, the Family Office Real Estate Magazine, and is a frequent speaker at family office conferences around the world. Most recently, DJ was a Family Wealth Alliance finalist for its Best in Industry Awards for Thought Leadership and Special Industry Contributions Award. He is also a past editorial board member for Real Asset Advisor Magazine, is the past president of the Harvard Real Estate Alumni Organization, and a prior board member of the Real Estate Academic Initiative at Harvard. DJ and I have a great conversation just about some basic things around family offices. What is that? Who should consider a family office? And he is an absolute expert in this space. It is incredible. And you're going to hear him share just that. I learned a lot from him. I know you are as well. I hope that you have subscribed to the show and are sharing it with your friends as well. I hope your business or your personal investing portfolio is benefiting from listening to the show. We'd love to hear from you. I would appreciate a written rating and review as well on iTunes. And you're always welcome to email us, info@lifebridgecapital.com. We'd love to hear from you. If you have a specific guest you'd love for us to interview, or a topic you'd like for me or a guest to cover, we would love to hear from you. As I have traveled, as I have met so many people in this business and space who are growing their net worth, all of a sudden they need to learn about this thing we call family offices. And it can seem daunting, can seem overwhelming. I have some friends who all of a sudden they sold a business, or they inherited a large amount of money, and they don't know what that means to have their own family office or to manage that capital well. Our guest today is an expert in that. And his name is DJ Van Keuren. DJ, welcome to the show.
Hi, thanks for having me.
Yeah, honored to have you. DJ, I want to dive right in because this is an important topic to our listeners. We have many passive investors. Our passive investors listen to the show, and many of them want to know more about this topic, the family office. Maybe give us a broad overview of family office and maybe your path to becoming an expert in this space as well.
Yeah, so currently the last number that I saw from the number of family offices in the world actually is about 15,000. And that's about 7,300, 43% here in the US. That number's gone up probably about 10, 15% or so. And that definition is based around having a minimum net worth of 250 million or more. And, how I fell into this was, I was an advisor in the 90s. I was in real estate from 2003 until currently. And about 7 years ago, I fell into the family office space. And that's where about 95% of the people that work for a family and how they fall into it it's just by that. They fall into it. And so I worked for a billionaire here in Colorado. And we were not only buying real estate, but also putting 100 million into oil and gas. We had 3 people actively trading equities. We had a foundation. We had 7 solar parks, and realized, look, I just need to continue to focus on real estate. So I got headhunted by the Heyman family, Giorgio Perfume, Giorgio Beverly Hills, and came up with the first boutique office brand strategy, which is doing very well. And then there wasn't much more to do. So worked with a younger gen that owns one of the Major League Baseball teams, and then formed Evergreen, where we were a consortium of families. And over that time, I've been asked to speak at conferences literally around the world. So I've met a lot of people, and I've been able to really understand the space.
Nice. DJ, as you are helping so many people learn about family offices, I would love to talk very basic, but then, be able to dive in a little deeper for those who are a little more experienced as far as developing their own family office. But initially, you mentioned the definition of 250 million or more. Is that the standard? Is that when somebody should think about having their own family office, when they have the 250 million in net worth? Or, is it when they have 10 million? Or how do you look at that or consider someone having their own family office?
So the phrase family office has really been coming out over the last couple of years. It's really based upon not only dealing with the family's investment side, right? Which is what I call the hard side of the business and allocations. But it's also dealing with the soft side. That can be anywhere from, making sure the jet's where it needs to be, making bill pay, paying the bills, looking after all the properties that they own personally. But it also has to do with succession plans and governance and making sure that there's cohesiveness within the family. And that's what we call the soft side of it. So for someone to hire an internal CIO or a chief investment officer, it's usually at about 750 million to $1 billion when they do that. When you get down to 250, then or under, you start looking at more of a multifamily office to work with or an outsourced CIO. There's people before that have said, well, if you got $10 million, you can still have your own family. Well, family office, you can, but you're not going to be dealing with what the true definition of a family office is, which is, if you ever watch Succession, I mean, that's a legit issue. There's just so many nuances that money causes issues with. And the more money you have, the more issues and the more planning that's needed. And so always planning is important, regardless of how much money you have, whether you have $1 million and you want to pass it on, or you have $100 billion. It's just the complexity of the planning and oversight that's needed.
Now, I think that's so helpful to think through that, as there's numerous listeners I know that have considered thinking about their own family office and friends that I have. But, you mentioned, if you have less than the 750 million, considering like a fractional family office type arrangement, what does that look like? And how does that work, and just to ensure that, hey, maybe that's a good path for me?
Yeah. So there's two things that you really need to understand is that there are people that'll say, well, we're a multifamily office, right? And they'll have multiple clients, but they only focus on the investment side. They don't focus on all these other issues. And when that is the case, they're really just a RIA, registered investment advisor. They're not looking at the holistic component, which always needs to start with governance. And governance is the number one thing that families need to put in place, because that dictates how you're going to be making decisions and within the family. It could also include having a quarterly meeting where the family gets together to talk about various things, et cetera. But, a real multifamily office, and there's probably about 6 or 7 of them, large ones that are out there, like BMO Family Office, Bank of Montreal Family Office, or Whittier Trust, which is out of California. And they have about 10 to 12 families that they focus on. And that's really all the time that they have to truly service and oversight. And also in the real multifamily office, they also have a back office that they could be doing the bill pay. They could be doing other components of it, or they might have 6 analysts looking at deals all the time. And so everything is thoroughly scrubbed going in. And so I think it's a matter of saying, how holistic are they really looking at everything? A lot of times planners will say, okay, well, you've got your investments and insurance. Well, there's a lot more to that, and the complexity varies too, based upon how much money you have.
I love that thought about just a holistic approach. It's not just about managing my investments. And so I've not heard too many talk about that as far as a family office. And you talk about even bill pay, to getting the whole family together, to discussing the path for the entire family, because it's going to affect all of them in a big way. While we're on that, though, what are some other things holistically that maybe a family office, does for this family that maybe is not often talked about, or somebody starting their own family office, they wouldn't even know to expect? You mentioned earlier, even having the jet where it needs to be, or, what are some other things that we wouldn't typically think about the family office doing for us?
Well, I'll tell you, the first thing that needs to be done, and by the way, depending on the size of the family, I mean, I even know multifamily offices and regular single family offices that even have a psychiatrist on staff. I mean, just because we all have issues with family at some point in time.
Yeah.
Right. I mean, there's times with your brother or sister or father, mother, whatever the case is, everybody has some type of dynamics. Well, you add hundreds of millions of dollars to that, it just changes even more that dynamic, right? And, I think there's a big stat that I'll let you know about how much money's lost actually by families by certain generations. But the first thing that anybody needs to do is what's called governance. And that is basically coming up with how things are going to operate and how things are going to be structured within the family itself. That's the first thing. And what else is amazing that doesn't happen uh, is you have these business owners, they've spent their whole life creating their wealth, whether it's in chemicals or tires or whatever. They sell the business, and they used to have quarterly meetings. They'd hire the best people to, run the company. They would have goals, objectives. I would say 80% of the time that the families and the family offices, they don't have a box to invest into. How much are we going to allocate here? How much are we going to allocate here? What's the returns that we're looking for here? What type of investments, et cetera? And that just blows my mind because that is, let's come up with what our objectives are. I mean, with your business, I'm sure you're saying, okay, this is what we're buying it at. This is the things that we need to do. This is the time frame we need to finish it by, right? And this is what we're looking for the outcome. And if it doesn't come out that way, then it's like, what could we do different? And so the other thing I would say is getting family members involved. I can't tell you how many times, even if you have sub $1 million, the spouse or the husband doesn't understand what's happening, where the money is, what's happening with the money, what's going on. I've tried to talk to my parents before about, well, there could be a day when you have to go leave where you're at and maybe go to another location. I don't want to talk about it. Well, that's family planning if you think about it, right? And it's affecting the younger gens. So it's the same way that you look at real estate, where whether you're doing a $10 million apartment or $100 million apartment, the fundamentals are the same. It's just that you've got another zero or two added to it and just more complexity, right? And that's the same thing from a planning perspective.
Yeah, no, that's awesome. So the governance, I love that. Yeah, it's like, how's it going to be structured within the family and getting all the family involved? I could not agree with you more. I have a family member who's a parent, owns a lot of land, and they're elderly. And I just said, well, do you all know what's the plan, for the land when they pass? And they're like, oh no, we haven't talked about it. And I said, well, you need to talk about it. Now's the time while they're still here, and so, but I know that they expect maybe tension around that. Right. And so they just avoid it.
That's the thing, is that it's like, let's not avoid it. And the very wealthy families, 50% of the kids don't want to even be involved. Right. Mm-hmm. I was at a conference, this is a number of years back, and this girl walks in and she's got like an exercise outfit on. And I'm like, so what do you do? And she goes, well, I teach Pilates. And I said, well, why are you here? She said, well, I think it's about time for me to sort of understand what's going on because I'm going to be getting all of this money, that comes in. And I'm thinking to myself, okay, well, we'll see how that goes. And when you look at even the definition, like we said, is 250 or more, 70% of families lose their wealth by the second generation and 90% lose it by the third generation.
Wow.
That means that only 5% get through the fourth gen. And that's a big problem, right? And it's not just, setting up a trust or, there's a lot more to that. And being good stewards of wealth, or foundations. And how are you going to, Warren Buffett is giving everything away, but his kids, put money into foundations they can run, right? So that's how he's sort of saying, all right, I'm going to give you a bunch of money, but it's for this purpose, right? And I think that's the extreme. But if you look at that, possibly even be part of the plan for the family, right?
Love that. I just thinking, I want to think through that. It's like 70% lose wealth by the second generation, 90% by the third, only 5% make it to the fourth generation. Tell me what's different about the 5%, even at let's say we've not made the 250 million yet. What are some things that any of us could be doing so our wealth, that does make it to the fifth or to the fourth generation, like that 5%?
Everything that we've been talking about, putting in a game plan in place, involving the younger gens about what needs to be done. I mean, there's a difference between creating wealth and getting wealth. That's why everybody that wins the lottery, they end up losing their money because they didn't know how to create it. So they just start spending it and it goes out. Same thing for the younger gens. They didn't know how to create the wealth. And so that's part of what needs to be done, not only the planning, but getting the next gens involved. This is what we want to accomplish. one of the best things that I ever saw, there's a gentleman, and he's passed, but he was fantastic. He sold his chemical company for about 400 million, I think it was, and older gentleman, and he had taken over the business from his father. And he gave his granddaughter $1,000. She was like 10, 11 years old, and said, okay, you need to give this away. So I want you to figure out where you're going to give it to and why you're going to give it to him. So she had to literally, and she got engaged. She was like, okay, well, I've only got $1,000. Where am I going to give it? Am I going to give it to this cause or that cause or for this? And so he was starting to have them engage to sort of learn about making decisions and the impact and the importance and everything else. And you can do that on the investment side too, to make sure that being part of some of the decisions that are being made. I mean, too often the patriarch, the matriarch built this wealth themselves, and that's all they've been doing. So they have what they're used to doing, which is controlling everything. Then it's like, well, you're not involving the other family members, and these are all things, regardless of your net worth, I think, that are really important.
Yeah, I love that, involving the kids. You and I were talking about masterminds a little bit before we started recording, and one of the guys specifically in the mastermind, they have an account, and I've talked to my wife. We're going to start doing this as well. It's like you have an account that's just for giving and involving the kids in, allowing them to say, hey, I want you to give this much away over this amount of time. I want you to be looking for those ways to give, right? And just helping them to start thinking that way, and just being generous, instead of just take. Right.
Yeah. And you can do the same thing, like I said, on the investment side. I mean, you can say, here's some, you got $1,000. What do you want to invest into? And nowadays you can do a lot of research online and ask, why is this? And what are you looking for? And stuff like that. So I think all of that is, very important.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Our guest today has been in industrial real estate for 42 years. And he came in an unexpected way, which he's going to elaborate on, but a very interesting path to real estate success, and a very different model than you've ever heard on our show. Yeah, I was trying to think back. Does anyone have a model like he does? And I don't know that we've talked to anybody that buys deals like he does. And it's probably one of the least risky ways that I've heard of. It's a way that we all know that could potentially be possible, but then many times we'll say, no, that's not possible, or we'll get a bigger return if we do it the way we've always done it. And so his name is Joel Friedland. 40 years in industrial real estate as an industrial real estate broker, owner. He's secured over 2,000 industrial property leases and sales. And you're going to hear a lot about that today. And I mean, he was crushed in 2008, and you're going to hear some details around that I think is healthy for all of us to hear and to be thinking through. So it's going to help you to think through the types of deals you're doing, especially in the economic cycle and market that we are in right now. I think this is a timely episode for everyone, whether you are an active investor or a passive investor. You're going to learn a lot from Joel today. Joel, welcome to the show. Honored to have you.
Thanks, Whitney. Great to be with you.
Joel is an expert in industrial real estate. He's coaching many people in this asset class and just in real estate. I'm looking forward to diving into some details. I know our investors are going to learn a lot today. Joel, give us a little more about who you are, though, and maybe what you're doing exactly in real estate, and let's dive in.
Sure. Well, I've been in industrial real estate, which is a very specialized area, for 42 years. I started out as an industrial real estate broker. I was hired by a family, not my family, but a family that was a father and two sons and a daughter. Their last name was Podolsky. And I met them through a friend of mine who was a childhood friend. I said, I want to go into real estate. And he said, I know this guy who's in industrial real estate, and you've got to meet him. So I'm a good cold caller. So I got the guy's number. His name was Milt Podolsky. And I called him and I said, I just graduated from the University of Michigan and I'm looking to be in real estate. He says, do you know anything about industrial? And I said, no. Industrial, I didn't even know what it was. And he said, well, why don't you come in? I need a property manager and I'm trying to hire somebody. I went in that afternoon. I remember sitting with him and his son walked in. And his son said, "Dad, I need a property manager right away." And his father said, "I've been talking to this kid for about 15 minutes and he's going into brokerage. He's not going into management." And the son said, "Damn it, Dad, you can't do that." His father said, "I'm doing it. This guy belongs in sales." He had a landscaping business and he went door to door and he got 70 people to hire him by cold calling. This was 1981. We were in a deep recession. Interest rates were 17%. And this family owned 84 industrial buildings and 10 of them were vacant and they couldn't fill them because tenants they just weren't moving. They were afraid. They had this fear that if they moved, they'd go out of business with interest rates like that in a recession. And the father said in front of the son, "Watch this, Randy." And he said, "So Joel, how are you going to fill up our empty buildings?" And I said, "Well, I think I would go door to door in the industrial park and call on companies and ask them if they want to move down the street." And he said, "Start today." That was it. So I became a leasing agent for this family and they gave me 10 vacant buildings to go fill up. And in my first year, I actually, as a broker, made 37 deals. I was a cold calling machine and I loved it. I was on a natural high. I struggled through school because I didn't really like being in class. I was bored. But this first year, learning the real estate business with these guys as mentors, it was unbelievable.
Cold calling machine. It's interesting how, man, just how things work out like that. You know, you didn't imagine that probably before that meeting, right?
Yeah,
Yeah,
exactly.
That's so cool. Well, how'd your path move forward then, as far as you going into industrial yourself? And I know you had a brokerage, and then what were some of the next steps that you took?
So I learned a lot about people and making deals. And for 10 years, I worked for the Podolsky family, and mentorship is everything. And these people were brilliant and they were experienced and they had connections and they introduced me to their people. And I introduced them to the people that I met through my cold calling. And I made hundreds and hundreds of leases and sales as an industrial real estate broker. There's a group called the Society of Industrial and Office Realtors. It's an international group. I'm a member of that. Industrial is a closed community, pretty much. It's people who get in and get trained by people already in the business, which is what happened with me. And there's a local organization called AIRE, AIRE, the Association of Industrial Real Estate Brokers. And so I'm a member of both of those, and I have relationships with brokers. And through all these years of working, I have relationships with investors and tenants. I was not an investor until my 10th year. And I went to Milt Podolsky and I said, "I have a feeling that you're as wealthy as you are because you own 84 buildings, not because you're a leasing agent." And he started laughing and he said, "I pay no taxes because of the way the tax laws work, but I make millions." And I said, "I want to be you." He said, "I'll be happy to show you how I do it." So he said, "Just go find a building to buy and I'll show you how to syndicate." So I went out and I found a piece of property. It was a $550,000 deal. And I brought it to Milt and I said, "What do you want to do?" He says, "Well, I'll put in the first chunk of money and I'll introduce you to my investors. You go cold call them and tell them I sent you, but you have to bring in the majority of the investors yourself through people you know." And I did. And we leased the building and we went and we did another one. This was 1989. And we did another one. And then I realized that the Podolsky family was not going to bring me in as an adopted son at age 30. I said, "Milt," and to his sons, Steve and Randy. His son, Steve, is this brilliant guy who knows all the details of every lease and all about the market. And Steve, to this day, is a friend of mine and is an investor of mine. But I left the firm to go start my own business. I had 3 partners. You ever watch the TV show, The Wonder Years?
Yes, that's been a long time.
Boy Meets World. Boy Meets World. The Savages. My partner was Lou Savage, who was the father of the stars of those shows. He was from Chicago and he was an industrial real estate broker. And he also wanted to get into owning. So he and I and 2 other guys started a business, friendly terms with my leaving of the Podolskys. And we went out and we started buying buildings and syndicating them. And over a period of about 16 years, we bought 70, 80 properties, and I brought in 300 investors, and I raised hundreds of millions of dollars. And it was all through getting to know people really well. They had to trust me, and they had to trust what I was doing. And I knew the industrial market cold because I had cold called almost every industrial building in Chicago. There's 8,000 buildings. I think I've cold called 7,000 of them.
That's awesome. Speak to, and we won't hang out here very long, but I wanted to, since you just mentioned that raising hundreds of millions and early in your career like that, and these people had to know you, of course, give a couple of tips about how you did that and how you raised that kind of money that fast.
It wasn't easy in the beginning because I had no track record. So I had to put together a pro forma, and we did an all cash deal. We did no mortgage. So the pro forma was one piece of paper. It was so simple. It was the property's worth $540,000. We want to get a 10% return. That means we need net operating income of $54,000, which means we need to lease it on a net basis. The industrial's all leased on a net basis. We'd have to get in about $65,000 a year in order to get the 10% return. I went to these people that were family friends or business associates, business friends, and everybody put in $20,000. So I had a whole big group, and I had to put in $20,000 because they said, if you're not putting your money in, we're not putting our money. And it was successful, but I have to tell you what happened. Things were great. There was very little. We had a little recession during the Gulf War in the early 90s, but for the most part, 2001 was tough. So I've been through some cycles, but things were on the sort of the upward trend in industrial for all that time. And in 2008, I got crushed. I got cocky. I started believing that what I was doing was my fault and that it wasn't luck. And what I realized, I was in real trouble. I thought I had lost everybody's money. I had 50 properties and I had loans on all of them at 7 banks. And 62 people had loaned me money with individual promissory notes. And I went into a depression. You see that couch behind me? I had that couch then and I was on it and I couldn't get off. My wife and my parents were watching me because they thought that literally I was so depressed that I could go take pills in the bathroom and end it all. It was really, really frightening. I was terrified because I thought I had brought all these people in and I was a big shot and now it was going to just fall apart. So I got some professional help. I saw a therapist and I got some medication to help me out of it. And I came out of it and I worked really hard and we didn't lose all of our money, but it took a long time to climb back up. I was a different man.
That was 2008 time period?
Yeah.
Well, what changed? How did that change how you look at deals, how you moved forward? How did that affect you moving forward? Now I know, low debt is something you're big on. I want to hear about some of that. Maybe that came from that experience. Yeah. Speak to some of that.
Have you ever heard of the concept that it's possible that some real estate buyers and developers are actually compulsive gamblers? Like, do people, you ever hear that someone say, I'm a deal junkie? You don't want to be an anything junkie. That's not good. Yeah. So if someone's a deal junkie, what they're saying is that I do deals and I'm not necessarily making good decisions. What I learned from being in that depression is that mental health really affects how people make decisions. If you're mentally healthy, I think you think through what the consequences are going to be of your decisions. But if you're not mentally healthy and you're elevated and you think you're really hot, you might go make some decisions that have very dire consequences because you're not thinking clearly. And I figured out that during that period of many years with multiple partners, I was doing a good job. I was doing the best I could. But what's changed is I realized that I was gambling because I was borrowing like everybody else. And I'm not saying that everybody in real estate's a gambler, but many people are. There's this guy, Keuren, who was one of the big billionaires. He owned hotels and casinos. There's a book about him. It's called The Gambler. It's no accident. And I decided that I could never gamble again. I loved casinos at the time. I used to go all the time. I'd bet on sports. I decided I can't gamble anymore, and especially in real estate. So I set a boundary. And my boundary was stay mentally healthy. Don't get elevated. Don't be a deal junkie. Be super careful. And that's what I've been doing. And my line in the sand is different than anyone I've ever heard of. And it's okay with me, even though people think that I might be an idiot, which is I do deals now with zero debt. They're all 100% equity, which means I have to work a lot harder to raise more money. But it resonates with very wealthy people because they're in it to not lose. They're not in it to get rich. That's really important.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.